Today we're talking about chapter 3. I would say that out of the first 3 chapters that are going to be on your first exam, this one should probably provide the most challenge. So we want to make sure that we pay a little bit extra attention to this chapter. We want to make sure that you read it. This would be definitely one that I would read. I think you could possibly get by on the first 2 because they were review without reading. But this one, the author is going to use a lot of stepped up language that you may not have heard used in your Accounting 100 class. So we're going to focus on some of those words and some of those concepts today. But I would encourage you guys read this chapter, and this would definitely be one that I would consider outlining. And if you're not sure what an outline looks like, or if you've never used that as a study technique, email me or come and see me in my office, and I'll show you an example of what an outline would look like for a chapter. I've gotten through school all my life by outlining, and so I strongly believe in the importance of it. It helps reinforce the concepts, and it helps you zoom in on anything the instructor is emphasizing in the class as well. Okay, so let me share my screen. I always like to start off by making sure we all know what's coming up and what's ahead. So let me get my schedule. You guys should see my schedule on the screen, our schedule on the screen. Unfortunately, I assigned chapter 3's interactive video a little bit later than today. So I think only 4 of you watched it. I was hoping you guys would watch that prior to coming into class, because I think it would make the lecture much more meaningful. But that was my my decision on making it do a little bit later, because I didn't want to give you 2 in 1 week. So to be 100% prepared for the chapter today, we should read it for sure. We should watch that interactive presentation, video presentation, to give us an overview. That will be the second time you've seen it. And then coming to class today would be the 3rd time, ideally, that you would see it. And then practicing the homework should come fairly easy for you after working on some problems in class. So this chapter is a bit of a review, but there's also, again, it's dialed up from Accounting 100. A lot of the adjustments that we're going to be working on today, you saw in Accounting 100, but most of the time it was the author giving you the amount, and all you had to do was the journal entry. So in this chapter, we'll be computing a lot more of the amounts. We'll be asking ourselves what accounting assumptions require that we record these adjustments. And then I'm going to get you used to using some terminology, and I'm going to give you some tips today for remembering it. On every single one of these adjustments that we do, I want you to know whether it's an accrual or a deferral. So you'll hear me use those 2 words a lot. Accrual, A-C-C-R-U-A-L, accrual versus a deferral. I'm going to tell you the difference today during the lecture. And I'm also going to ask you, is it an accrued revenue or an accrued expense? Or is it a deferred revenue or a deferred expense? So there's some wording there that might be new to you. And that goes from using, again, a 10th grade reading level book in Accounting 100 up to a 14th grade reading level in this chapter. So we're going to work on that terminology. We're going to work on a lot of exercises and problems today. And those of you that have had me before know that I don't give a whole lot of bonus points or extra credit, but I'm going to give you the opportunity, if you're interested in earning a few bonus points. And it's because of the environment we find ourselves in. And so I'll get to that here in a second. So let me just put the agenda up there. Our focus today, I've split this up into 2 days. Today, our focus is solely going to be on the adjustment process. What do we need to do to get our books in accordance with GAAP, or generally accepted accounting principles? And what we need to do is we need to make adjusting entries. And there's 2 major types. There's those words spelled out. And then I also want you to be thinking, what would be the effect of the error if I either omitted or forgot the adjustment, or if I didn't do the adjustment correctly? What would be the effect on the financial statements? And then I think we'll probably wait until the next class to go over the review of the financial statements. We'll see how much time we have today. But my focus for today's class is going to be on the adjustment process. Okay, so if I had you guys live in a classroom, I would start off by giving you this team project. This is in the modules link. And it's called Chapter 3 Team Project. And this is where I'm going to give you the bonus points. If I had you live, I'd put you into small groups in the classroom and I would give you this project. And during class time, I would tell you this. This is about the simplest business you can have. It is a lawn mowing service. And many of us, including me, used to do that to earn extra money when I was a teenager. I would go cut the lawns for my own family, although I don't remember my dad paying me, but I would definitely do it for neighbors and I would get some money along with babysitting, right? To be able to buy the things I needed when I was young. So this is the bonus project. I don't have you guys in live classrooms where I can put you in small groups of 3, and it really doesn't work well in a Zoom environment. So to encourage you to try this project, I'm going to give you some bonus points. If you do the project and get it 100% correct, I'm going to give you 5 points. And think of this as, 5 points might seem measly, but it's like adding 5 points to your test score. So when you look at it in that perspective, I would strongly consider doing it. So what I'm after on this, and I'll send you guys an email with the specifics, I would like you to try this either on your own or with a classmate or 2. I'll let you decide what you think is best. And I want to see, let me shut my email so you don't hear that beep. I want to see T accounts, which I've provided to you. I'll show them to you in a second. I want to see T accounts, a trial balance, and an income statement. Okay, so if you decide to try this project, I want to see T accounts, a trial balance, and an income statement. And I know the requirements at the bottom are different. This is actually a final exam question from Accounting 100. It wasn't my final exam, but it is a great exercise in determining why accruals and deferrals are so important. And again, this is a lawn mowing service. It's not rocket science. It's about as basic of a business that you can get. And as I recall the teacher telling me, one person out of a class of 35, one person got the whole thing right, even though they had completed a whole semester of Accounting 100. So I want you guys to attempt it. And I want it, if you're going to attempt it, I want it finished and emailed to me. And very clearly in the subject line, I want you to put bonus points project and your class 101 by Friday night at midnight, because I'm going to send you guys the solution this weekend so that you can use it also in preparation for a test. So I'm going to read it together with you because I really miss doing this in class. It would show you the importance of why adjusting entries are so important. So I'm going to read it to make sure we all have a good understanding. And then I'll start you off with the first couple of transactions. And what I wanted to show you on this project is even if you miss one simple transaction, because these are all very simple, even if you miss one, all 3 financial statements are going to be incorrect. So one of the things I want to focus on today is that accruals and deferrals always involve an income statement account and a balance sheet account. Every single adjustment that we're going to do in here involve an income statement account and a balance sheet account. So if we mess it up, or if we omit it, if we forget to do one of these, all 3 financial statements are wrong. And the same thing goes out there for these large multi-million-dollar companies. If they don't do an adjusting entry right, if their auditors aren't in there focusing on, did they do these adjustments right? All 3 of the financial statements are wrong. So we're going to read it. Jack Roberts formed a lawn service business as a summer job. So in your head, picture going out and mowing lawns and collecting money. That's about the basis of the business. To start the business on May 1st, he deposited $1,000 in a new bank account in the name of the proprietorship. Okay, now because this was an Accounting 100 project, it was a sole proprietorship. So we'll be using capital in this one, just like we did last semester. That $1,000 consisted of a $600 loan from his dad and $400 of his own money. Okay, stop. That's a transaction. So you guys have the T accounts in the modules link. I'm going to bring them up here. And what that would look like is, I'm going to put another column in here so I can label it. I would label that transaction A, or you could, however you want to label them is fine. I'm going to put transaction A. This is the business's books. So that transaction where there was $1,000 placed in the business, and part of it was a loan from his dad, and the rest of it was his own money, that's a reportable transaction. I need to go read the amounts again. Whoops, wrong one. 600 loan from his dad and 400 of his own money. So here's how you would record that one. I would have $1,000 a debit to cash. I would have a credit to loan payable for the amount that he borrowed from his dad. I hope it was 600. I'll have to go look again. And the rest was his own money. That means he has $400 equity in the firm. Let me go make sure that's right. $600 loan, $400 of his own money. This is what I mean about recording the transactions. Okay, that's the first one. And I would code these with a letter. You can make up the letter. The letters aren't going to be on there. I'm going to make those red so they stand out. So I would expect, if you want to try this, when you're all done, I would expect either this Excel spreadsheet, or you can do it by hand. It doesn't matter to me which one you do. I want to see the completed T accounts. I want to see a trial balance to ensure that your debits equal your credits. And I want to see that income statement. Okay, so I'm going to go and do one or two more with you. Jack rented lawn equipment, bought supplies, and hired high school students to mow and trim his customer's lawn. At the end of the month, he mailed bills to his customers. On August 31st, he was ready to dissolve the business and return to college for the fall semester. Because he'd been so busy, he had kept few records other than his checkbook and a list of amounts owed to him by his customers. Okay, typical small business. Many times I'll have a client come into me literally with a box of receipts, a shoebox with receipts. Sometimes there's a checkbook, sometimes there's a bank statement, and they'll say, here it is. I don't know how to do my taxes, do my taxes. Okay, so it's kind of this guy. He's a college student. He's just trying to earn some money. He's throwing all his stuff in a box and he's saying, here, figure it out. So here's a check figure. At August 31st, his checkbook shows a balance of $1,640. That is a check figure. So if I go back over here to my T accounts, I'm going to come to the bottom of this cash account and I'm going to write that balance in, which means as a check figure, when I'm all done, I have 1,640 in my cash account. I'll put EB for ending balance. This was given to us. This is a check figure. We know that it's accurate. So that should give you some comfort. After you do this cash account, you should wind up with 1,640. Okay, let me go do, I told you I'd do at least 2 transactions. So here's the first one. His customers still owe him $500. Okay, that's a reportable transaction. That's why we have this chapter. If someone owes you money because you've completed some work, in this case, he mowed some lawns, we need to get that on the books. Why do we need to get that on the books? Because GAAP says you record revenue when earned, not when received, but when earned. And it says his customers still owe him $500. I need to put that on my books. So I'm going to call that transaction B, and I'm going to go back over here. And when somebody owes you money, you use accounts receivable. And I'm going to give that transaction B. My accounts receivable went up by $500. Why? Because GAAP says you record revenue when earned. What's the offset? Because we know when we do journal entries, we better have a debit and a credit for each transaction. The offset would be some kind of revenues. You can call it whatever you want. I think I'll call it lawn mowing revenue. Service revenue would even be okay. 500. My debits have to equal my credits, of course, every single time. You're going to go through and record all those accruals and deferrals. And by the way, since we're talking about that right now, I'm going to give you an easy way to remember what is an accrual and what's a deferral. Here's the hint. There's some terminology in there. The question you want to ask yourself when you're deciding whether it's on homework, and I'm going to use that on every single homework question, I'm going to get us in the habit of using the words accrual and deferrals. The question you want to ask yourself, has the cash changed hands? Has the cash changed hands? If the answer is yes, it's a deferral. If the answer to the question of has the cash changed hands, if it's a no, it's an accrual. So I'm going to ask myself right now, has the cash changed hands on the $500? The answer is no. Well, how do I know that? They still owe him. That's an example of an accrued revenue. No cash has changed hands, but we need to put the revenues on the books because it's owed to us. If he forgot that one, or if you forget it on the bonus project that you're working on, then two things happen. You have two errors on your financial statement that affect three financial statements. It means that your revenues are understated, right? And it means that your assets are understated because you forgot to put that accounts receivable on the books. If your revenue's understated, that has an effect on the net income. That means your net income's too low. And if your net income's too low, that goes right into capital. That means your capital's too low. And when you get to the balance sheet effect, it means that your assets are too low if you forget to put that receivable on the books. So if we were in class, we'd be working through this. And usually there's not one group. Sometimes one person in a group might get it right. It's usually they argue with the group members and they change their mind. So because we don't have that environment where I can put you guys in groups very easily, we're going to go ahead and you can try that on your own. It's like adding 5 points to your test score. I'm going to do one more with you. The next one, during the summer, he collected $5,200 from customers. So most of his customers probably gave him cash when he walked up to the door and said, okay, I completed your lawn mowing. So during the summer, he collected $5,200 from customers. Okay, well, when he did that, his cash would have gone up by $5,200 and his revenues would have gone up by $5,200. So no adjustment needed for that as far as like end of the term. That just would have been what he should have done when he mowed the lawns and created the cash on the spot. So that's what I expect you guys to do. I'll send you out an email confirming that. Let me put the wording just so maybe Julie, if you could take a picture of this, or Thamir, or anybody else in the room, really. If anybody wants to take a picture of this and post it in the chat room, then they don't have to wait for me to send the email out, but I will be sending you guys an email to review this. So these are bonus points. They're available to everyone in the class, whether you're taking the in person or taking online. 5 points if you complete it and get it correct. 3 to 4 points if you complete it, but you got a couple errors. Normally it's a team project, so you can decide to either work on it by yourself or you can contact another class member. A lot of you had Accounting 100 together. So if you'd like to work on it with somebody else, that's okay with me. Email me the completed Excel file, or you can do it in paper and pencil, doesn't matter. I need it by Friday night. Attach your work. So you have Wednesday, Thursday, and Friday to work on it. And that's because I want to post the solution for everybody by Saturday when a lot of you study. In the subject, I didn't write that subject on email. I want you to put Accounting 101 bonus project, right? Make sure I know what class you're in. I have 6 different classes. And so if I don't see that on the subject line, I may not grade it. And I want to make sure that everybody that wants to give this an attempt receives the points. Any questions on that?
Professor, I just had a question on that last transaction that you just did.
Yes.
Yeah, so with the 5,200 being collected immediately, like just assuming that, would that be neither a deferral or an accrual?
Yes, it would not be either because the financial statements are correct as they are.
Okay.
When he recorded that cash, that would be accurate. Accruals and deferrals are adjustments we need to make that don't involve cash usually. None of the adjustments that you're going to see in this chapter involve cash, because cash is recorded by all companies, usually when it's received. It's that offsetting item that is usually wrong between the cash and accrual-based companies. So we're going to talk a little bit more about what that means. Cash-based companies, by the way, it is not GAAP. You cannot use it. Cash-based companies record revenues when received and expenses when paid. It's not GAAP, but a lot of small businesses do it. What we know as accounting students is we're following something called the matching principle, which means we have to match the revenues and expenses in the same period. So the terminology that your book's going to use, we have a revenue recognition principle that in a nutshell says revenues are recorded when earned. And we have an expense recognition principle where we say expenses are recorded when incurred, right? And another example that your book gives are these prepaid accounts. If you were a cash basis company, if I paid 2 years worth of insurance, if I'm cash based, I'd expense it all right away, because a cash basis person expenses it whenever it's paid in cash. We know from a GAAP standpoint that you can't expense it all when paid. We need to figure out what period does that amount benefit and charge it to the expense in the period that it benefits. And so this question is a great way to point out accruals and deferrals that many people will miss in class. Another one that a lot of people will miss on this one is the supplies that the company used. Right? So we got to remember that supplies adjustment. Supplies are assets until they're used up. So you're going to read in this team project, when the guy buys the supplies, they should be an asset. And when he finds out how much he's used up at the end of the year, that's when the deferred adjustment needs to take place to record the supplies used up. And so this is a great practice exercise, especially for assessing how much you remember from Accounting 100. If you get them all right, you are an A student probably, and you don't even need to study this chapter. But if you miss one or two, that's going to show you the importance of why we're talking about accruals and deferrals. Any other questions? Anything you saw on the screen with the directions on how you're going to submit this? It's not going to be through Canvas because you're doing bonus work, right? I'm going to add in to Canvas some bonus points that I'll occasionally give. And some of you might be saying, 5 points, it's not worth my time. I think it's worth your time for 2 reasons. It's a great learning tool. It's something that we would be using in the classroom if we were all together. And it's like adding, if you can get 5 points, it's like adding 5 points to your test score. I would think that would be worth the investment of time. You'll have to balance that out with all your other responsibilities. Okay, any other questions before we head on? All right, so that's normally how I would start off the class. So this is the handout, also in the modules link. We'll talk a little bit about what we see on the handout, and then as usual, we'll spend a good deal of our time working through exercises and problems. Again, you've had all these adjustments in Accounting 100, but the author's going to dial up the level of difficulty. He's going to make you think critically on a lot of these adjustments, whereas in Accounting 100, you may have done it, but they usually just gave you the amount. So that's where we're headed. So your author starts off by talking about the difference between the cash basis and the accrual basis. And again, I want to be very, very upfront. The cash basis is not GAAP acceptable. It's not a generally accepted accounting principle. But some companies that don't have to worry about reporting to anybody, they just do it because it's easier. So under the cash basis, they recognize revenue when cash is received, as opposed to when it's earned, when the revenues are earned. Okay, so we know from having a whole semester of Accounting 100 that we don't follow the cash basis. We follow the accrual basis of accounting, which falls in line with that matching principle. A cash basis taxpayer would recognize expenses when they're paid. Okay, we know that that's not accurate. We know that that might work for some small mom and pop that doesn't report to anybody, but anybody that has a bank loan or has to report their financial statements to outsiders, they got to follow the accrual basis. They will record the amount when incurred, regardless of when it was paid. Back to that prepaid insurance example. If I was paying today for 24 months of car insurance, a cash basis person would record the whole thing as insurance expense right now because that's when it's paid. But we know that under the accrual basis of accounting, we got to figure out how many months have passed in the accounting period and then prorate that and record the expense as it's incurred as the time passes. We're going to practice this. Cash basis is not GAAP. The accrual basis is mandated by GAAP. In other words, if you, again, have a bank loan or you are doing financial statements that have to be in accordance with GAAP, you don't have any choice but to follow the accrual basis. Net income for a cash basis person would just look at your cash account, and your cash received would be income, and your cash paid would be expenses, and your net income is equal to the cash. But for GAAP requirements, we know that revenues are recorded when earned and expenses are recorded when incurred, and that profit has nothing to do with how much is in your cash account. It's the difference between those two components. The cash basis has very questionable comparability. The accrual basis, which mandates that all companies use this, is on the same level playing field and we all use the same rules. It ensures comparability between companies and between periods. And although the cash basis may be useful for business decisions, we know that profitability is a very important component to our investors, to our shareholders, and so that's why GAAP requires it. When you guys take 102 and you take a managerial based class, you'll be looking at a lot of decision-making tools that are based on cash. But for external reporting purposes, which is what this class is all about, we have to use the accrual basis. So let me stop for a second, see if you have any questions on the difference between the cash basis and the accrual basis, and I'll be happy to answer them. All right, you learned this in Accounting 100, but I think it bears repeating. Adjusting accounts is necessary under accrual basis. So any company that uses the accrual basis of accounting will be making adjustments at the end of the accounting period. So it's necessary for transactions that extend over more than one accounting period, right? So if you buy a fixed asset like a computer or a car or a building, that asset's going to live more than one accounting period. And so depreciation's going to be an accounting adjustment because that asset extends over more than one accounting period. This needs to get in your notes, probably in your own handwriting. Every single adjustment affects an income statement account and a balance sheet account. Why is that so important? Because if you mess it up or you forget it, all three financial statements are going to have errors on it. And so these accruals are really, really important. And your author gives you 3 steps. So I'm hoping you guys have read the book. There's a 3-step process, and I wrote down the steps. Determine what the current balance of the account is right now. Decide what the balance should be, and your adjustment is going to be made for the difference. You're going to see me do that today. Here's some other things I want you to write down in your notes. Every single adjustment can be categorized as a deferral or an accrual. And there's that magic question: has the cash changed hands? If the answer is yes, it's a deferral. If the answer is no, it's an accrual. I'm going to go one step further today. When we work on our exercises, I'm going to have you choose from 4 different types, and that's what you're going to see on the test. I will ask you this. Here's your 4 choices. I will put, and I'll list an adjustment. I'll give you an example in a second. The four choices you're going to see on the test: is this a deferred revenue, a deferred expense, an accrued revenue, or an accrued expense? That's what you're going to see on the exam. So I'm going to give you an example. The supplies adjustment, let's use that. Okay, has the cash changed hands? Yes, you've bought the supplies. They're sitting in your account. Therefore, supplies adjustment is an example of a deferral. Okay, is it a deferred revenue or a deferred expense? Well, supplies can't be a revenue. That's an expense. So the supplies adjustment, you would answer it's a deferred expense. When you're having trouble, go back. Has the cash changed hands? Yes, the supplies were bought. They were placed on your books. The cash has changed hands. Then we know it's a deferral. Then you have to ask yourself, does that affect a revenue or an expense account? Supplies affects an expense account. Therefore, it's a deferred expense. So I want to work with you on the terminology because that part probably is foreign to you. Questions on that?
Yes, Professor, I had a question. Like, is it like for what one company does, can that be like an accrual, and then for the other company it'll be a deferral? Like if you look at it like say you finance a car, and then it's an accrued expense because you have to pay the monthly payment, but for you it's also a deferred expense because you have to account for depreciation.
Okay, that's a good question. Depreciation is always going to be a deferred expense because remember, the cash has changed hands. You may have financed it, but that car dealer, he got paid from somebody, the bank. So the cash for that car has changed hands. Depreciation on any asset is always a deferred expense. So it doesn't matter how a company, if it's financed or not, the car company, the one that sold it to you, they've gotten the cash, you've bought that car, it's on your books. So depreciation, the reason we call it a deferred expense, the asset's sitting there on the books. You're deferring recognizing the depreciation expense until the time has passed and the asset has started to lose its usefulness. Okay, so it's a great question. This is designed to just kind of help you place the two. So if I get my car, even if I financed it through Toyota, the cash has changed hands at the dealer. That car is paid for. It's sitting on my books as an asset. I'm going to defer writing off the car or expensing it to depreciation expense as the time passes, because as the time passes, my car loses its usefulness, not its value necessarily, but its usefulness. Okay, and always prepaids, if you see the word prepaid, it's always going to be a deferral. If you think about that, that makes sense, right? Because if you're prepaying something, that means the cash has changed hands. If you're prepaying, the cash has changed hands. So anytime you're using a prepaid, that is a deferral. Why? If we use prepaid expense, or a prepaid insurance, I meant to say. Why is that a deferral? Because it's sitting in a prepaid account on my balance sheet. I'm deferring recognizing the expense until the time has passed so that my insurance policy loses its value. Hope that makes sense. So I think we could look at terminology all day. I think what I'm going to do for the rest of today, we're going to jump in and get our hands dirty. We're going to go through some fairly easy examples, and then he's going to dial it up on our homework problem today. So my goal is to get through one easier problem and then go to that last harder problem, which is an example of what you can expect to see on your test. And as we do these, even though the book doesn't ask us to classify these on your homework problems, I'm going to classify each one so that you get into the habit of asking yourself, is it an accrual or is it a deferral? So even though I know your book doesn't always ask you that in these exercises and problems, I know what's ahead. So I'm going to be asking you repeatedly. And I would encourage you guys, as you do your homework, you've seen me encourage you to do it on a piece of paper or on an Excel spreadsheet so that you have a record of it in your binder. I would always go off to the right and I would go further, one step further, classify those on your homework as well. Okay, let's go grab our Excel spreadsheet that you should have downloaded for today. We have 3-6, we have 3 problems, 3-6, 3-11, and 3-2B. I'm going to go through one of the easier ones. That's this one. I think this one will mostly be a review. And then I'm going to jump in and go to that last one, which is going to challenge our brains. He's going to really be making us think. And so that's going to be the challenge for us today. So questions before we go any further. All right, these won't be too bad because you've done these before. And if you're looking with this in your book, you could find this exercise. I meant to write it down on page 125. If this is hard for you to read, especially if you have 2 screens, you might want to have the book open on one screen. What I've tried to do in this class is put the problem in an Excel spreadsheet simply so I wouldn't be going back and forth and driving you guys crazy with trying to demonstrate these. Okay, they gave us a chart of accounts, partial chart of accounts. And so we want to try and stick to these accounts that they gave us. And then they gave us, let's see, 6 or 7 adjustments. Letter A, depreciation, is going to be our first one. We're all familiar with how to do accumulated depreciation. We're familiar with the straight line method. So in this chapter, he's going to give us the amounts. When we get into another chapter, chapter 8, I think, you're going to learn 4 ways to depreciate assets. If you were in my class in Accounting 100, you heard me tell you that there's probably about 20 different depreciation methods. He's going to walk you through 4 of them in chapter 8. For right now, he's going to use straight line, and I think he usually gives you the number. So letter A says depreciation on the company's equipment is $18,000. Okay, here's what I want to ask you. Has the cash changed hands? Yes, the equipment is on the books. We own the equipment. So because of that, this is a deferred expense. Okay, we know it's a deferral because depreciation literally means you're deferring, expensing, writing off that asset until it's been used up. So every month or every year, depending on how the company does it, they have to expense a portion of that asset's cost. This happens to be for equipment. So I'm looking at their chart of accounts. They do have a depreciation expense for equipment, and the credit would be to accumulated depreciation. I'm going to move this over. Just need to get the amount. It was 18,000. And that would be to record the depreciation for the year. When we go back to that Jack's, if you guys do that Jack's lawn mowing service, a lot of students miss the depreciation adjustment. They forgot that he had some equipment at the end of the year that needed to be depreciated. A lot of clients don't know how to calculate depreciation. And so they wait for the auditors to come in and to do it for them. So again, things to note, every single one of these adjustments is going to include an income statement account and a balance sheet account. And if they forget to record this or they make the adjustment for the incorrect amount, all 3 financial statements are going to be affected. So I'm going to come out here and we're going to categorize all of these. So this one is a deferred expense. I'm going to put that in red so it stands out. A deferred expense. Why? The asset's sitting on the books. Cash has been exchanged. Okay, it doesn't even have to be cash. It could be other things as well. So the asset's sitting there and we're deferring the recognition of the expense until the time is used up. The depreciation is a loss of usefulness. And so rather than recording all of the assets cost in one period, we learn to portion it out over the years. That's what GAAP requires that we do. So that's the first one. Any questions on letter A? Letter B, the prepaid insurance account had a $6,000 debit balance. Now we have to read really carefully. he's going to go back and forth on the wording on these things. So you really need to read it. It says the prepaid insurance account had a $6,000 debit balance of December 31st before adjusting for the cost of any expired coverage. Now, he could have gone one of two ways on this. He could have told you how much had expired, or he could tell you how much is left unexpired in the prepaid. He will go back and forth. So you're really going to have to read. It says an analysis of the company's insurance policies showed that 1,100 of unexpired insurance remains. That means there's 1,100 left in this account. And what we have to do on that one is figure out how much has been used up. So when you get your calculators out and you take 6,000 minus 1,100, you're going to get 4,900. That's the amount of expense that has expired. That's what we need to record. Okay, so how do you do that? Well, this is insurance expense and a credit to prepaid insurance. Half of you will make that for 1,100 and half of you will miss it. He told you how much was unexpired and you had to figure out the amount that had expired. Okay, so I'm going to write that in there. And here comes the new part also. Last time we were here, we said we were going to go one step further and we were going to classify these. Okay, has the cash changed hands? The answer is yes. How do I know that? It's a prepaid. The cash changed hands when we bought the policy, when we first bought the policy. Therefore, it's a deferral. And because it affects an expense account, it's a deferred expense. And that is to record the expired insurance for the year. The adjusting process necessary to follow GAAP's matching principle. We're following the revenue recognition principle. And in this case, in these two, the expense recognition principle. Letter C, the supplies account. Here's another one where you got to watch it. He will go back and forth on the supplies. Sometimes he'll tell you how much is used up, and sometimes he'll give it to you the other way and make you figure it out. So I always draw a picture because I know how he goes back and forth. It says the supplies account had a $700 debit balance at the start of the year, and $3,480 was purchased during the year. On December 31st, the physical count showed 300 of supplies available. Sometimes he'll tell you how much is used up. Other times, like today, he's going to make you figure it out. Okay, so how do you do that? I've got my calculator here. You're going to subtotal the supplies. 700 plus 3,480. On my calculator, I get 4,180. And of that amount, 300 is still left. And so you guys check me. When I do the math, I get 3,880 as the amount of supplies used up. So we know how to do that one. We did it last semester. Supplies expense. And the asset account supplies is going to go down by 3,880. I'm going to take it one step further because I know what's ahead. Has the cash changed hands? The answer is yes. The supplies are on our books. We've bought them. We're deferring, recognizing the expense until the supplies are used up. And so this is another example of a deferred expense. Anything that starts off as an asset and you're deferring, recognizing the expense, that's a deferral. Questions on A through C?
Yes, Professor, I had one question.
Yeah.
So for supplies, I just want to know like kind of like the logistics of like how they come up with how much is used.
Mhm.
Is there like some type of perpetual system where they scan like a supply that's been used and it like shows up on some type of manifest or something like that or some type of document that's in a computer, or is it all done by hand, like they count the supplies?
Yeah, so if companies are really technically sophisticated, everything has barcodes and they'll do it in and out. I rarely see supplies done that way. What I see is one time at the end of the year, because it's not worth their time to do it any more often than that. Same thing with me. I'll go into my supply cabinet and I'll literally say, look, I got a stack, a ream of paper and 2 ink toners, right? And I eyeball that and I say, oh, that looks like it's about $300. And the amount used up would just, you take whatever's in your supply account, however much you spent it, for me, it's Staples that year, and subtract out the stuff that's still in the cabinet. It's not anything that takes me a long time to do. It's literally okay, a couple reams of paper, a couple printer cartridges. It's about 300. This amount is adjusted.
And then you use what you purchased it at, not the current value, right?
Oh, no, just what you purchased it at. We got to use the cost principle. Definitely what we purchased it at.
Okay. Thank you.
Yeah. Yeah. So during the year, every time I go to Staples in my general ledger, I just hit supplies, 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 and it goes up, 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 up. But when I go to my cabinet, I realize, well, I used a lot of that this year. So open up the supply cabinet. This is about how much is left. Now, typically at clients, they'll be a little bit more accurate. They'll show a physical inventory sheet of the supply cabinet and they'll cost it out. And whatever's in their supply account, they write down to the inventory. That's how it works. Some companies, Thamir, since I know you're an accounting major, some companies do it backwards. They expense everything. So every time they go to Staples, they hit supplies expense. And then at the end of the year, they'll go take a look in the supply cabinet and they'll say, oh, we do have some stuff left. We over-expensed it. So they will debit supplies and credit supplies expense to fix it. Give me 1 second, guys. I have to put this power cord back in. I hope I don't lose you guys. Hopefully that makes sense to you.
Does that create like an auditing issue?
No, as long as they fix before the auditors come in.
Okay, all right.
No, it has the same effect. Okay, so we said that was a deferred expense. Yes. All right, D. 2/3 of the work related to a 15,000 of cash received in advance was for performed this period. This will be the one, if I gave this on a test, letter D would be the most missed. Okay, so let's read it again. 2/3 of the work related to 15,000 of cash received in advance. Okay, stop. When we receive money in advance, right? If I'm going to do somebody's tax return and I want a retainer because they have tax issues, I want them to be able to pay me. So I get a retainer up front. That's money that I've received ahead of time. That's sitting in this unearned revenue account right here. A lot of people mistakenly think that's in a prepaid. Prepaids are monies that you've sent to somebody else. This is money that we've already received in advance. So that 15,000 is sitting in the unearned revenue account. So what we need to do on this adjustment is to adjust that unearned account downward to reflect the amount of money that has been earned. So if you're looking, remember about that unearned account, it's kind of a weird account. It's the only liability account that you may have learned that doesn't have the word payable. So because it's a liability account, it looks like that. I put the rule up there. And what they just said is this 15,000 that's sitting in there, it needs to be adjusted down. For how much? They've done 2/3 of the work. So I need to take 2/3 times 15,000, and that's going to be in my head anyways, 10,000. That's what I need to make the adjustment for. The 10,000 that has now been earned. Okay, so how do I do it? if you're looking at that account, I debited the unearned, I debited that liability account, and I'm going to credit some kind of regular old revenue account. And when I look at their chart of accounts, it looks like the regular old revenue account is called services revenue. Okay, so let me put that 10,000 in. And we'll put a brief description to record 2/3 of 15,000 received in advance because work was performed. A lot of students get that mixed up with the prepaid. And unearned is actually the flip side of a prepaid. The person that paid that retainer to me, they would have a prepaid on their books. It has value because if I back out and say, you know what, I don't want to do your tax return, I got to give them the money back. All right, so this is a flip side of a prepaid. It's on the person's receiving side. So has the cash changed hands? Yes, they got the cash ahead of time. And so because the cash has changed hands, that's a deferred expense, or sorry, a deferred revenue. It's a deferral, but it's a deferred revenue. Why? The money was received ahead of when it's earned. So the cash has changed hands. We're waiting until the work is performed. That's what defer means, to wait. We're waiting to record the revenue until the work has actually been performed in accordance with the revenue recognition principle. All right, letter E, prepaid rent had a $6,800 debit balance before adjusting for the cost of expired prepaid rent. And on this one, again, he goes back and forth. This time, instead of telling you how much was unexpired, like he did on the previous one, he just came right out, he gave it to you. He said, by the way, 5,800 has expired. So we don't really have to do any work to get that example. He just came right out, tried to confuse us by giving us other numbers we didn't need, but he just came right out and said that 5,800 of that prepaid rent has expired. Okay, so that would be rent expense and prepaid rent. And he just came right out, told us it was 5,800. And that would be to record expired rent. So we're going to classify it. Has the cash changed hands? The answer is yes. It was sitting in a prepaid account. The cash has definitely changed hands. Any prepaid, the cash has changed hands. So therefore, it's a deferral. And because this one hit an expense account, it's a deferred expense. So hopefully most of this has been a review. Again, maybe the terminology might be a little challenging. That's why we're working on it. But most of these calculations you've done. And letter F, wages expense have been incurred but not paid. Okay, wages expense have been incurred but not paid. GAAP says you got to record the expenses when they're incurred. So it doesn't matter that they haven't paid it. You're going to see this happen on the lawn mowing business. It said the guy still owes his friend some money for mowing the lawns. GAAP says you got to record that expense when it was incurred in the same period as that revenue that he generated. So for this one, wages expense, and I can't use cash because he said he hasn't paid them yet. So I got to use a payable. We'll use wages payable. And the amount he gave us was 3,200. And I'm going to write a description to record wages incurred, but not yet paid. And then we're taking it one step further. Has the cash changed hands? The answer is no. It has not yet been paid. So if the answer is no, it's an accrual. And this is an accrued expense, accrued expense. Why? They've incurred the cost, but they haven't yet paid it. No cash has changed hands. And so they have to accrue the expense because of the matching principle or the expense recognition principle. That's the easier adjustments. I think much of this is a repeat. You got to watch the wording though, because he's sneaky. He'll switch up the wording, right? But that's how it happens in practice. You don't have somebody always following somebody's rules. They tell you what happened. Here's the facts, figure it out, go record it properly. And again, to refresh your memory, if any one of these adjustments would have been forgotten or omitted, or if any of these, I'm commonly doing transposition errors. If you would have flipped the numbers, maybe I write 8,500 down here. All three financial statements would be wrong because every adjusting entry affects a revenue or an expense account, right? An income statement account. And every single one of these affects a balance sheet account. So all three financial statements would be messed up. And by the way, adjusting entries, I hope you noticed in all of those, they never affect cash. They never affect cash. Questions on that before we go try some brain twisters? Okay, then I'm going to drop to the last problem, the 3-2B. This will be the one, the homework problem, that I get all the emails on this weekend. So the hardest one on here is the one, unless they switched it up from last year. Oh, I think they did. They made it much easier for you guys, so I might not get as many emails. There's one in here, maybe we're doing it next time, where there's like a bunch of insurance policies. And they make us sort through the insurance policies and come up with the proper answer. But this one, I think they changed it up. And so maybe it's not as hard as I thought it was. Usually when the authors revise the versions of the book, they tend to make the problems more difficult, not easier. So this will be one where I'm mistaken. It wasn't as hard as I thought it was going to be. Maybe we'll be doing that next time. Let me pull this one up. Give me 1 second. Questions on accruals or deferrals or anything else that you've heard of that you're not quite sure about?
I had a question, maybe
Sure.
just like starting, like the adjustments and stuff, or like what happens if a source document is not like correct? Does that affect like the balance of the accounting equation and everything, like the financial statements in the end?
So when you say a source document, are you talking like what happens if I get an invoice from Staples that have the wrong amount?
Yeah.
Yeah. So I would initially assume that it's right. When I go to Staples and bring an invoice home, I'd record my supplies at whatever that invoice says. But I know we've all had this experience where we look at the receipt and go, oh my gosh, this was on sale. They charged me too much. So when you go back to the store, hopefully you would get a revision or a return or some other type of source document to help correct it.
Okay.
Yeah.
Thank you.
You're welcome. All right, let's read, unless you guys have questions. It says the company's annual accounting period ends on October 31st. Okay, that presents a little bit more of a challenge. So we're so used in Accounting 100, we got really spoiled with calendar years that sometimes we need to go back and remember what a fiscal year is. And a fiscal year is any consecutive 12-month period. It doesn't even have to be the end of a period. I think Starbucks uses an in the middle date on their financial statements. So a fiscal year is any 12-month consecutive period that a company chooses to use. Most companies will choose their fiscal year end at the lowest point of their business year. And that usually has to do with physical inventory counts that are required. Either cycle counts or a physical year-end count. And so because inventory counts are very expensive, they try and pick a time when inventory is at their lowest, and because the company's not as busy as well and can handle an audit. All right, so fiscal year 12/31, I might just draw myself a picture because sometimes I need to think through depending on the wording of these. So we have fiscal year that ends at 10/31 and a new one that starts on 11/1. Keep that in mind. Okay, they give us a partial listing of accounts, and letter A talks about the office supplies account. And so I'm going to create a supplies T account. Right before you guys came in, I just made a little T to make it a little bit neater. It says we started the year with 600. I'm reading from letter A. In fact, let me put a little letter A in here in red so it sticks out. And I'm going to right align that so that you guys see it. All right. We start off with 600. They bought supplies for $45.70. So I'll add that to it. And be careful, he'll go back and forth. It says the supplies available at October 31st totaled 800. So they went in and they did that quick and dirty inventory of their supplies account, and they came up with a balance of 800. So what you guys will have to do is to figure out how much has been used up. So I'm going to add the two items on the left-hand side and then subtract out the balance that's still there. So I added up the blue and pink cell, and then I subtracted out that ending balance of 800. When I did that, I got 43.70. They asked us to do the journal entry. So we'll come over here. I'm going to make a couple small columns so I can indent. Supplies expense and supplies. $43.70. And then again, I want you guys to get into the habit of asking yourself, what kind of an adjustment is that? Well, supplies are assets. They've been paid for. They're sitting on our books. That is a deferred expense. I'm going to put that in red as well, because I want you guys practicing that every single time. So that's pretty typical of what we just did. I probably got you guys psyched out for a really tough problem, and then they changed this significantly, made it much easier. So letter B talks about the prepaid account. And again, he goes back and forth. In this one, he does tell us how much is unexpired again. Okay, so read the wording. Letter B, he's going to tell us how much is unexpired. So I'm going to make another T account. I'm going to take the supplies and I'm going to just copy it down here for us to work on. And I'll get rid of the numbers and we'll make this time for a prepaid account. And we'll put down what we know and we'll figure out what we don't. He said there was a starting balance of 12,000. I'm on letter B. He said that an analysis of the prepaid insurance shows 7270 of unexpired. I'm going to write that word down. He'll go back and forth. He'll do another question on a test where he'll just tell you how much is expired. But this time he tells us how much is still unexpired, how much has value to it. So I'm going to take the difference between those two. I got 4730. So the adjustment for that one would be to insurance expense and prepaid insurance, 4730. You know what I'm going to ask you next. I want you thinking about it. By the time the test rolls around, it should be second nature to you if we do it enough. Has the cash changed hands? Yes, it's a prepaid. It's changed hands a long time ago. Therefore, it's a deferral. And since it affects an expense, it's a deferred expense. Trying to work on the wording, the new wording that you guys may be getting used to. Letter C. I remember this one causing a problem, so we'll have to read it really carefully. Letter C, and if you guys have problems reading that, let me make it bigger while we read it. The company has 4 employees who earn a total of 1,000 for each workday. Okay, so 4 employees together, all 4 of them earn $1,000. They're paid each Monday for their work in a 5-day work week ending on the previous Friday. Assume that October 31st, going back to our little timeline here, October 31st is a Monday. So there's the last day of the fiscal year. That means that 1 day worth of wages would need to be accrued, because on that cutoff date, our employees had only worked 1 day, Monday, for which they had not been paid. Okay, now he could have said that it was on a Wednesday, then you'd have to do 3 days worth. So you got to watch the wording with this one. There's 1 day worth of work, and they mentioned to us that all 4 of those employees earn $1,000 a day. I think he could have been a little bit clear on the weight on the wording for that one. So let's see. Well, I got to move this out of the way because I made it bigger. Give me 1 second. So on that exercise, we are going to, let me get rid of that C. That's what happens when I move things. I'm sorry, you guys. I know that's a little bit confusing. Let me get my letter C in there. What we're going to do on that one, we're going to do wages expense and wages payable for $1,000 because the workers worked only 1 day on the last day of that fiscal year. I believe if we go look at the chart of accounts, I actually think they use salaries expense instead of wages. Those two are synonymous, but since they gave you a chart of accounts, let me change that. Salaries expense and salaries payable. Either one would be okay. And that is to record 1 day of wages. Has the cash changed hands? The answer is no. They won't get paid until Friday. It's 10/31 and they've worked 1 day for us. So because the cash hasn't changed hands, this is an accrual as opposed to a deferral. This is an accrued expense.
Professor, I just wanted to point out something.
Sure.
Isn't it 1,000 per employee?
No, that's why I said they could have worded this better. Let's go read it again, because I questioned the same thing when I did it the first time. The company has 4 employees who earn a total.
Okay, all right, yeah.
I could see though, the mirror, where that you might be making that mistake, because he could have been a lot more clear with the wording, but in total, they earn $1,000 for each workday.
I apologize.
No, that's fine. He could have worded it that there's 4 employees each who earn $1,000 a day. Then you would have had to multiply by the 4 employees and it would have been for 4,000. Yeah, and I wouldn't put it past him to switch up the wording either. So you got to read it really carefully. All right, letter D, the company bought a building at the beginning of the year that costs $175, has a $40,000 salvage value, and has a predicted 25-year life. He gave us all that information simply to tell us that annual depreciation is $5,400. So he gave you all those facts and then decided to just give you the amount. So there's nothing to calculate, but I would encourage you to calculate it anyways, in case he throws you that on an exam. Okay, so letter D would look like this. If he did not give us that amount, I want to make sure you guys can calculate it. We would take cost minus the salvage value, and we would divide by the life. So even though he gave it to us, I just want to use this time to make sure that you guys know how to compute depreciation using straight line. So this is what it would look like. Let's see, 175,000 less 40,000 divided by 25 years. Since they had it the whole year, there would be no reason to depreciate this. So let me calculate that really quickly using my Excel formula here and make sure that we get the exact same amount that he gets. So I'm going to press equals in a second, or enter in a second, and see if we came up with the same 5,400 that he comes up with. And I do. Okay, so we did that just in case he asked you to compute it on another one. So depreciation expense for the building and accumulated depreciation expense, or not expense, accumulated depreciation on the building for the 5,400 that he gave us, but you guys should be able to calculate. Okay, you know what I'm going to ask you next. Has the cash changed hands? The building's been built. It's sitting there in an asset account. You're deferring recognizing the expense until the asset is used up. So little by little, you're recording a portion of that $175,000 cost to an expense account. You're deferring recognizing the expense until the building is used. Well, every month that we hold that building, it's losing its usefulness. It's being used up. So that's a deferred expense. Any questions on A through D? Okay, letter E then, if I don't hear any questions. Because the tenant does not occupy the entire building it owns, it rented space to a tenant, because a company does not occupy the entire building. It's renting space out to a tenant at the amount of $1,000 per month, starting on September 1st. The rent was paid on time on September 1st, and the amount received was credited to rent revenue. Okay, so September is good. They got the money. It's in the books. We don't have to worry about September. However, the October rent has not been paid. The company has worked out an agreement with the tenant who has promised to pay both October and November rent in full on November 15th. Okay, that can be a little bit confusing. So what do we have to do as far as GAAP is concerned? GAAP says you record revenue when earned. Okay, we own the building. We've earned some rental income. September was fine. That wasn't the problem. It's the October rent that has not been paid. Remember when our fiscal year is 10/31. So our cutoff date is how much revenue are we going to recognize on 10/31? So the answer to that would be, if I read it again, the October rent has not been paid. That's $1,000. The company has worked out an agreement with the tenant who promised to pay October and November rent later. Okay, later on, after the fiscal year ends. So what do we need to do? We need to recognize revenue when earned. There's $1,000 of rent that needs to be recorded as earned. So for letter E, some kind of a receivable. And if we look at their chart of accounts, they didn't have a rent receivable. So we'll just go ahead and use their generic accounts receivable. And if we go back and we look at that chart of account, we're looking for some kind of a revenue account. And there it is, rent revenue. So that's what we'll use for the credit. And that would be for $1,000. And some of you might look at that and they said, hey, they're going to pay November too. Remember, that falls outside of the fiscal year. The fiscal year here ends on October 31st, just 1 month to accrue the October rent income that still hasn't been received. Okay, has the cash changed hands? The answer is no. They haven't given us the cash yet. So by default, it's an accrual. I know it's an accrual because no cash has changed hands. So then your next choice, is it accrued revenue or an accrued expense? In this case, it's an accrued revenue. So it's an accrued revenue. Questions on that one? That's similar to the one we just worked with, the Jack's lawn mowing business. Remember, there was $500 of lawns that he'd mowed, but he still hadn't collected. That's the same type of an adjustment. He needs to put that money on the book because he's mowed the lawns, and so he needs to record that. Same type of adjustment. Companies, since I know I have some accounting majors in here, there's cutoff issues. When you go out to audits, you look at transactions that occurred near or right after the cutoff date. And what you have to decide is, did they record all the revenue that they should have recorded, right? If they shipped the goods out and it was a normal shipping term of FOB shipping, if they ship those goods out on the last day of the fiscal year on 10/31, they need to record that revenue and they need to record the cost of goods sold related to it. And so a lot of you will be going out and working in audit areas, not a lot of you, maybe 5 or 6 that I'm aware of anyways. There's cutoff date, there's cutoff tests that you will do as an auditor, and that would be one of them. And then the other test you do as an auditor, you look at revenue coming in the first week of the new year, and you make sure that that revenue was either recorded in the last prior year, if that's applicable, or that it was recorded in the current year. You take a look at those transactions to make sure there's not any revenue recognition issues going on.
I have a question. Maybe it's like, so how does, like, being that Amazon is like a international like type of thing, do they go by like jurisdiction, like USA, for example, and then they set a time to where they account for all the accruals for like a region, or is it like by the whole country, or how does that work?
That's a really good question. They usually pick the company's headquarters, and whatever time zone they are in, that's the rule that everybody follows. Now, I could be mistaken if that's changed recently, but Amazon is an international, worldwide company. And I'm not sure where they're headquartered. I should know that, but I'm not sure where they're headquartered. That would be the time cutoff date that they use. It's a really good question. All right, letter F. On September 1st, the company rented space to another tenant. So think of this big building, and they got a little bit of the building that's being unused. And rather than let that place go vacant, they're renting it out to some tenants. We just saw one tenant that was falling behind on their rent and owed them $1,000. Now here's a second tenant. On September 1st, the company rented space to another tenant for $725. This time though, the tenant gave us 5 months rent in advance. The payment was recorded in that unearned revenue. Remember, a lot of students get this confused with the prepaid. Prepaid's money that we pay out. This is not that. This is money that we got in advance. We got it in ahead of time. Somebody said, you know what? I need some space. I want a big discount on my rent. So a landlord might say, great, pay me 5 months up front and I'll give you a big discount on the rent. So $725 amount was the amount per month. The tenant paid 5 months rent in advance. So we're not recording the initial transaction, but just let me show you what it would look like. 725 times 5 means that originally they got $36.25 and they put it into the unearned account. I'm writing sideways. I apologize for the messy writing. That's where it's sitting. What we are required to do is to make the adjustment to bring this up to date. So what you got to ask yourself is, as of the cutoff date of 10/31, how much of that was earned? September's earned and October's earned. So 2/5 of that would have been earned. That's one way to look at it. So let me do that on my calculator and then I'll show you the other way to look at it. times 2 out of 5 will be $14.50. The other way to look at it is, hey, it's $725 a month. We would have earned 725 times 2. You'll get the same answer no matter how you go about solving it. So letter F, none of these affect cash. None of them. Adjusting journal entries don't affect cash. So what needs to happen is that unearned account, remember what it looks like. I'll put a little T account. It's a liability account. And so what we need to do is make that liability account go down with a debit. I'm not sure if they called it unearned rent or just unearned revenue. Let me go look at that chart of accounts up here. Unearned revenue is the name of it. So let me go back down here and fill that in. Unearned revenue. And then we know where to put it in the regular old rent revenue for 2 months worth of rent that we have now earned. So the $14.50 we calculated earlier to record the earning of 2 months of rent out of 5 months. Let me let you catch up and then I'll ask you the magic question. Magic question, has the cash changed hands? The answer is yes. They got all that big prepayment up front, that unearned revenue up front. They have it in their hands. The cash has changed hands. And so that means this is a deferral. And that means this is a deferred revenue. Questions on that before there's one last little part of this problem, the part that will throw people off. So any questions on those first 5 or 6 transactions before we take a look at the subsequent transaction that your book's going to talk about? Okay, you guys are really quiet today. We did number 1. It says prepare the adjusting entries. Boom, we got that. Here's the part where I'm going to get the emails. Number 2 says, and by the way, never do I not like your emails. I don't mean that like, oh, a drudgery. I just mean this is where I'm going to need to be prepared. And Julie, you're going to be getting questions too. Prepare journal entries to record the first subsequent cash receipts or cash transactions for November for parts C and E. Okay, I'm going to go highlight C and E so we can look at those. So C was this one. I'm going to make it green. And E was this one. So what they're telling you is this didn't finish out the transaction. There were some subsequent payments that were going to happen on these 2. And they want to see, again, accounting 100 cranked up here. They want to see what would those subsequent receipts or payments look like. Okay, well, remember what this one was. This was the one where we were recording 1 day of wages. Well, when that pay period ends, they're going to be paying 5 days of wages, right? But one of those have already been accrued. So I'm going to come out here and put the subsequent payment of wages is what they're asking for on this one. Okay, well, the total is going to be 5,000. They're going to pay their employees 5,000, right? But one of those thousands has already been accrued. So I need to get rid of that liability because it's not owed anymore. So when they make that payment, and I think if you go back and you look, it tells you that the first payroll happened on November 7th. So I'm going to put that date up there to help you figure it out. That would be when all 5 days of wages were paid. All right, well, let me get rid of that liability because once I pay the payroll, it's no longer owed to them. So 1,000 comes out of that liability. The salaries expense is going to be for 4 days in this new fiscal year. So I'm going to put in parentheses 4 days. So $1,000 a day times 4,000. Why only 4,000? Because 1,000 of that got recorded in the last fiscal year. So here's this fiscal year. This is the new fiscal year. Here's what goes in that period. And the credit would be to cash. Every payroll, they're probably paying $5,000. That's not changing. What changes is the subsequent payment. This is not an adjusting entry because this makes me look like a liar. We just got done saying, hey, adjusting journal entries don't affect cash. This isn't an adjusting entry. This is a subsequent payment. So to record the subsequent payment of the week's wages. And then this one, remember this one, we can go back and read letter E, but that was the one where the guy was going to come back and pay 2 months worth of rent right here. It says the company worked out an agreement with the tenant who is going to pay both October and November rent on November 15th. So now what they're asking you is, okay, hey, what would you do on the subsequent receipt of that money? Well, remember, the tenant's going to bring you in 2 months worth of rent. So you're going to recognize all the cash. He's going to bring you 2 months worth of rent. So that would be 2,000. But I can't put the whole thing to rent revenue because I've already recorded $1,000 worth. So here's this receivable sitting over here. If the guy brings you the rent that he owed you, we got to get rid of this receivable because he doesn't owe it anymore. And so what I would do is bring that accounts receivable down by 1,000 because it's not owed anymore, and put the new rent revenue on the books for this fiscal year for the 1 month for November that is being paid. So this is to record the subsequent receipt of the rent for October and November. Part of it was already recorded in this last fiscal years because GAP said we had to do it. And the other half of it is now recorded in this fiscal year as a regular old accounting transaction. That's the tougher part, I think, of that chapter. So these are subsequent receipts. We wouldn't have to classify them. Thamir asked a good question about, what exactly is an adjusting entry? We don't have to classify those. They're not adjustments. They're just regular transactions that happen during the year. That's the first half of the chapter. I think out of chapter 3, this is the part that's going to give you a little bit of headache. It's this half. The second half is going to be the financial statements and the closing process. You guys already know how to create financial statements. Of course, that statement of retained earnings is new, so we'll focus on that. And you guys already know how to close accounts, but in case you've forgotten, of course, we'll practice that as well when you guys come back. So questions on anything having to do with adjusting entries or what they are, why they're needed, or how we classify them? Anything related to any of that? I hope that helps you do the homework. Let me go back to our schedule here. So here's what I would do. I would love for you guys to be able to use next week to study and even have a fun long weekend, not this weekend, but next weekend. So I think you guys know enough to do all of chapter 3. It's not technically due until next weekend, but let's see if we can crank out at least half of chapter 3. And if you have extra time, maybe get all of it done. Wouldn't it be nice to actually spend that extra week reviewing for the exam and even maybe having a little bit of fun on the holiday that's approaching, not this weekend, but next weekend? That's what I would encourage you to do. So write the due dates, please, on a calendar. I just had a student come into my office and tell me why they accidentally missed a homework assignment. And I was explaining to her, I have 200 plus students in 6 classes, and I can't be going in and unlocking things for 200 students. So we got to get those due dates down. I put them in my cell phone calendar, and I tell my cell phone to alert me 24 hours or sometimes 48 hours before something is due, so I don't miss out on those things. So by the time I see you next time, the chapter 3 orientation will be done. It's due. The chapter 2 homework will be due. And I would try and get at least half of chapter 3 done, at least the half we did today. And I would try to get into those Learn Smarts. I made them optional this year based on a lot of feedback that I got from students, but I do think you'll see them increase your test score by quite a bit if you attempt them. And then again, if you weren't here at the start of class, make sure you watch the recording. I'm giving you guys an opportunity to earn some bonus points, 5 bonus points on doing a project that I introduced at the start of class on a lawn mowing business. It was actually a final exam question in an account, not mine, but in an Accounting 100 class. We talked about it at the start of class. Here it is on the screen. It's called a team project. You can choose to work by yourself or with somebody else. You're going to create a set of T accounts, a trial balance, and an income statement. And you'll send that to me by Friday night if you want to try and earn those bonus points. I'll send a reminder email out. Last thing I want to tell you guys is in the modules link, don't forget that there's lots of opportunities for assistance. Julie, I believe, has worked on that problem as well in her class, but if she hasn't, I'll make sure that she has an answer. You guys have these options. I have virtual office hours. I was in my office this morning. I had 1 student come in. You can come in anytime before class. Julie is our embedded tutor. She has hours here on Monday, Wednesday, and Friday. Maybe it would be a good thing if you guys could work it in to try it tonight or tomorrow so that you can Zoom with her either right after class or maybe Friday works out. And one of the 2 of us will help you, even if it's this weekend and Julie doesn't have the Zoom. You can email her and ask her, hey, can we set up something? I'm just not getting this bonus project. Or you can email me and say, I'm really stuck on this transaction or that transaction. Or maybe Thamir attempts it and says something like, I got net income of, I'm pulling in a number out of the air, 5,000. Can you tell me if that's right? Right? Can you tell me if I'm on the right track? I'll email him back and say, yeah, you got net income. Or I might say, no, Thamira, that's not it. Send me what you have so far and I'll guide you, right? I'm not going to leave you guys hanging with no help. And then we also, going back to the introductory module, you guys also have these instructor tutorial labs, and they are throughout the week as I've pointed out to you. I'm going to open this up. Even if you go to a tutorial session for no other reason, I would go meet Mr. Osaki. He has connections like you wouldn't believe with the Big 4 accounting firms. He used to be the recruiting director for one of them. I have personally seen him get 2 students into Big 4 firms that got rejected when they tried to do it on their own. And Professor Osaki put in a good word for them. They went and re-interviewed the person, and the 2 that I'm thinking of, one's in the LA office for Deloitte, one's in the Orange County office for Deloitte. They are happily employed by a Big 4 firm and they're thriving. So the other reason I would encourage you to drop into these tutorial labs is definitely to get help, right? You could bring that problem in and say, I'm just stuck. I know my net income's wrong, but I don't know how to find it. And maybe I'm not available. Maybe I'm babysitting. Go into one of these labs and those instructors will also help you. All you got to do is click on their Zoom room during the times listed. So there's lots of opportunity to get help out there. Any questions on anything we've talked about today? Anything you've heard me say?
Yes, Professor, where can we find the Excel file related to the extra credit?
Okay, I'm glad you asked, Thamir, because there's probably other people at home that want to find that too. I believe in the modules link, let me go share my screen and we'll all make sure we find it together. So let me go back here. Let's all go to the modules link. And if I go down to chapter 3, I think, let's go look at the handouts. Okay, here's the directions for the team project, and here's the T accounts for the team project. So download those to your computer. Remember, they'll download in like a downloads file. So you'll want to make sure that you save them to your computer before you email them to me. We don't want them to get lost in cyberspace someplace. So I'm glad you asked. They're in the modules link in the chapter 3 handout section. Here's the instructions that you saw on the screen, and here's the T accounts for Excel. Do you have to know Excel to do this? No, you can do it on a piece of paper. You can chicken scratch out your T accounts as well, or you could print out that Excel spreadsheet, hand pencil it in and scan that to me, or take a picture and scan that to me. I don't care how you do it. I just want you guys to have the opportunity to try it. And then if you choose not to do it, I do not want to hear from you on the last day of class when you're begging for, 7 or 8 points to push you up to the next grade. I'm going to go back and say, oh, did you do the chapter 3 bonus points? And if you did, and you got 5, now you're 2 points away. I'm going to probably give you the 2 points. I'm not going to hold a grade from anybody for 2 points, but 8 or 10 points, that's something different. And so take advantage of those opportunities. Good question. Anybody else have any questions? When's it due? The bonus one? Friday night. Friday night by midnight, because I want to post the answers for you guys to be able to check your work. And the bigger value in this to me is go through that and ask yourself, are these accruals or deferrals when they are adjusting entries? Almost everyone we talked about today, except for maybe the unearned ones, almost everyone we talked about today is going to be in that little simple landscaping or lawn mowing business. So give it a shot. Let's see what happens. I'm not leaving you in the dust. I'm here to help. I do have a lot of babysitting responsibilities and a lot of business meetings built in, but between the two, I can guarantee you that we will get back to you if you need it. All right, I think Julie only had the library reserved for a certain hour time, so she left early, but she will be posting Excel files later in the discussions area if any of you are looking for that completed file. Thanks for coming in. Let me know if you guys need any help with anything. Bye.
Thank you.
Thank you.